It's your favorite YouTube guys, DS Learning Finance, financially educating you guys to freedom for the beginners by former beginner every Sunday at 3 p.m. This week's video is about what not to do in the UK stock market, so make sure to watch it before you invest. You see, I've invested in the stock market for several years now, guys, and I've picked up on a lot of the things that some beginner investments like to do, especially the ones that focus on long to medium term investments. So trust me when I say this, you're going to want to watch this, guys, because there are 4 big mistakes that beginner investors like to make, but also bad investors too. Can't forget them people as well. So if you guys don't do these things, then you're already ahead of those people in the stock market. If you like the sound of this, then make sure to hit the like button down below, subscribe to my channel with the notification bell on so that you don't miss any new videos like this, guys. Now, before I get started, it's important to stress that each of these 4 things have one thing in common. Now, I'm going to mention this towards the end of my video, but in the meantime, you guys can try and find out what it is. Now, in no particular order, starting off with 1, people relying on the share price too much. Now, the share price shows you at any given time what the price of each share is for that stock. The unit on the y-axis is in Great British pennies, whilst the x-axis is in time. In this recording, you can see the share price graph fluctuate for Rightmove stocks with a general trend upwards. This happened all the way until it reaches about 3 months ago, where it is followed by a very sharp dip. Why am I mentioning this? Well, it's because some investors like to use just the share graph, when simply put, there's not enough information in it to do so. You see, bad investors would look at that share price and move on to the next one just because it doesn't look good. Whereas if they look behind the scenes, guys, if they looked into more depth surrounding that stock, they would have realized actually Rightmove is one of the best stocks that's been performing over the year, guys. Yeah. So this just clearly shows that a lot of investors rely on the share price a bit too much when it comes to finding right stocks to invest in. You see, for me, I don't rely on the share price too much. Why? Well, it's because the share price doesn't necessarily show you what the value of the stock is. All it just shows you is what the public's perspective, what the public values that stock at. Doesn't necessarily mean it's a true value. This coupled up with the fact that there are market makers whose sole job is to actually increase and decrease prices so that there's more activity in buying and selling shares for a particular stock. Yeah, I know. So one day you can end up with one stock being really cheap and then the next day quickly rises up like that due to the market makers. So there are people actually setting prices in the market. And you want to rely on just that? You guys can clearly see it's not the way to go for a long to medium term investor. 2, the recent reviews surrounding that stock. So this can be what the experts think, what the gurus think, what the newspaper says surrounding that stock. All of this information causes a lot of investors to go astray. If an expert might have left a really good review on that stock, then that doesn't necessarily mean that you have to follow him. Why? Because some experts are actually paid to leave good reviews on certain stocks. Ask yourself this question: if that stock is as great as what this expert is claiming it is, then why haven't they invested in it? Why haven't they quit their job? Why are they here talking about it? Why are they letting the whole world know about it? And on the flip side, if there's a bad review, could there be a possibility that maybe this expert or this newspaper article or this guru is trying to lead people down the wrong path for their financial gain? Unfortunately, a lot of investors, bad investors and also beginner investors get sucked into this trap. Don't be one of them. You have to treat the stock market as a big ocean. Everyone's out for themselves, guys. It's the people who are the most equipped, the people who do the most research that are able to fend for themselves and prosper. For me, I can find really good reports on my stocks, and what that does is actually reinstates why I invested in that stock in the beginning. But at the same time, I can also find really bad reports on my stock. And more importantly, I look into more detail upon why that person feels that way. If I agree with those principles, then maybe I might act accordingly. If not, then I stick to my guts. It's important that you make the decision for yourself. 3, director dealings. Now this one is, to be honest with you, a very funny one. A director dealing shows you the activity of directors by buying and selling their shares in that company that they're part of. Now, the whole concept behind this is that directors, obviously being very influential figures in that company, therefore should have some sort of insight upon where the company is looking to go. So the idea is if the director sells their shares, then maybe some investors might sell their shares because there probably is something on the horizon, apparently. But also, if the director buys more shares, then maybe the investor might buy more shares just to follow what the director does. For me, this is a silly thing to do. Why? Because there's so many other reasons that could influence that director selling or buying more shares in their own company. Maybe they might have wanted to recently do their kitchen, so they sold more of their shares. Maybe it's time for them to take their profits. Or maybe they're worried about something coming around the corner. My point is, there's so many reasons, so many possibilities that could justify that director buying / selling their shares, but has such a huge influence on a lot of investors what they do with their stocks. Instead, an improved way to look at this might be looking at the portion upon which a director might sell or buy stocks in their company. You see, if they buy more shares than what they previously owned, then that might be an indication that something good is coming around the corner for that company. Whereas if they sell all their shares, then that might tell you guys, okay, look, it's time to get out of this stock. The proportion is a better indication, I feel. 4. Crowd following. You see, as humans, we naturally associate safety with following the crowd because everyone else is doing it and must be right? Wrong. Couldn't be any more wrong in the stock market. There's a saying that Warren Buffett made, arguably the best investor in stocks. And it's that you should be fearful when others are greedy and greedy when others are fearful. And that pretty much sums it up, guys. You have to think as a lone wolf. You have to act on your own accord rather than following what the crowd does. The crowd could be leading their way off a cliff for all you know. And these are my 4 mistakes that a lot of beginner investors and bad investors make when they're finding stocks. Now, the thing that they all have in common is that they all rely on a weak piece of information to justify buying that stock. Whereas if they had done adequate research surrounding that stock, they would have found several reasons to not invest in that stock. And don't forget to like, subscribe with the notification bell on. It'll really help my channel, and follow me on all of my social media platforms down below. But above all, have a good day, people. It's your favorite YouTuber, guys, DS Learning Finance, financially educating you guys to freedom for the beginners by Form Beginner every Sunday at 3 p.m. DS Learning Finance. Bye, guys.